Hello, my name is Laurel, and today I will be presenting an analysis and valuation of Patterson UTI Energy Inc. Patterson UTI Energy Inc. operates in the oil and gas drilling and exploration industry. It's headquartered in Houston, Texas. It provides onshore contract drilling services to major and independent oil and natural gas operators in the United States and Canada. The company operates in three segments, which are contract drilling, pressure pumping, and oil and natural gas. Contract drilling involves making wells for a variety of clients. And as of December 31st, 2015, Patterson UTI had 80 drilling rigs operating in the United States, which is 63% less than 2014. And in 2015, the revenue from contract drilling totaled $1.15 billion compared to $1.84 billion in 2014. Pressure pumping consists of well stimulation services such as hydraulic fracking, and cementing services for completion of new wells or remedial work on existing wells. In 2015, revenues from pressure pumping was less than contract drilling at $712 million. Oil and natural gas services are offered mainly in Texas and the Appalachian region. Patterson UTI serves independent oil and gas companies by providing comprehensive drilling services in these areas. In 2015, revenue from this operation totaled $24.9 million. For the industry analysis, currently crude oil prices are remaining low, and they particularly drive this industry, but with a lack of feasible substitute services and the increase in global economic growth, industry and performance is expected to increase. There's also supposed to be a global increase in demand worldwide, especially in developing countries like India and China. A shift to alternative energy. There's been a big push for that. A lot of people are thinking green and using products like solar and even coal or wind energy, geothermal, and so that's kind of affecting the industry a little bit negatively. Again, the price of crude oil will remain low with little improvement in sight. But natural gas is becoming increasingly easier to extract as a reflection of the new technologies available to extraction companies. And because of this, the demand is, while that's expecting to increase, the supply is also expected to be easier to extract, which will mean more profit for countries such as Patterson UTI. And there'll also be a lot more imports from Canada as well to the United States, and Patterson UTI is at an advantage here because it operates both in Canada and the United States. For the five forces analysis, the threat of substitute products are low. Like I mentioned before, there's a couple energy sources that are potentially coming up on crude oil or petroleum products, but they're not as efficient or cost effective. The threat of new entrants is also low. There's high capital expenditures to enter and leave, and there's a high degree of technical knowledge and skill required. Rivalry is very high. There's low product differentiation, high exit barriers, high fixed costs, and low industry growth. The bargaining power of suppliers is also high. There's few substitutes, the cost to switch is high, and the products required by Patterson UTI are very specific, so the suppliers really have an upper hand there. The bargaining power of buyers is also high. In this industry, there's low brand loyalty, and buyers are very price sensitive. Some recent events, again, the weakness of the price of the barrel. In 2014, it was up $105, and now it's fluctuating around $35. The low point was in December 2015, was at $28.68. Low commodity prices are negatively impacting spending as well, and that's causing a decrease in rig counts. Patterson Energy's rig count is declining just because there's not as much demand. There's not as much demand for any commodities, or as many commodities. Also, the customer base is made up of 10 large customers for Patterson UTI. Just one customer was about 13% of their revenue, so they're at risk of, if they lose any of their major customers, they could have a very large effect on their financial condition. The accounting analysis. Drilling contracts are formulated on a competitive bid or negotiated basis, which is dependent on location, equipment, risk, and duration. And they're on a well-to-well basis or a term basis. Pressure pumping contracts revenue is earned from a mixture of equipment costs, labor costs, and mobilization costs. The company believes that these contracts protect against anticipated losses. They're pretty typical for anyone operating in their industry. Property, plant, and equipment is stated at cost, and maintenance and repairs are expensed when incurred. Depreciation is straight-line basis over the useful life of the asset. And even if equipment becomes idle, it's still depreciated on a straight-line basis. Revenue recognition from pressure pumping and services is recognized as the services are performed. And accounting for interests in oil and natural gas properties, they're accounted for using the successful efforts method, which allows Patterson UTI to capitalize expenses associated with successful reserves. The capitalized costs are then depreciated, depleted, and amortized with the units of production method. Operating costs of unsuccessful reserves are expensed when the reserve is determined to be dry. This table shows a summary of the ratio analysis compared to firms that are also operating in the oil and gas drilling and exploration industry. PTN is on the lower end when it comes to profitability ratios, and this indicates the company is losing more money in operations than it's generating in sales. This makes sense, as PTN and its competitors would have low profitability ratios because of the low price of the barrel. As far as leverage, the debt to equity falls in the upper half. In this case, it might be better to be on the lower half because it indicates a lower level of credit risk. The EBIT interest coverage is not favorable. The ratio is an indication of the number of times a company could pay its interest in the current period with its earnings. The low ratio shows that P10 is not generating enough revenue to pay its interest expenses, which could cause lenders to be wary of offering loans. If you look at the EBIT ratio, that doesn't include depreciation and amortization though, that is increased significantly, which shows that the depreciation and amortization for this company is fairly high. And for the DuPont model, the basic DuPont is most affected by the negative net profit margin in 2015, which means that Patterson UTI did not produce sufficient income in relation to its sales. Revenues were particularly low that year, and if you look at this chart, you can see in 2015 the price of crude oil really declined in 2015, so that is probably why. Additionally, the asset turnover is also decreasing, which is due to less demand for petroleum services and slower sales. As far as the margin analysis, the main change in that is due to the net operating margin, which is affected by adjustments in depreciation, depletion, and amortization. And in 2015, one of the major adjustments was $130 million was charged as a result of a write-down in relation to mechanical rigs and their components. Depreciation is also a reflection of capital expenditures in past years to build, upgrade, and maintain rigs. CAPM was calculated to be 14.83%. This compared to 8.5%, and the difference between my estimate and Yahoo Finance's was I used the industry beta, and they used Patterson UTI's beta. For the WACC, the WACC is 7.023% as the cost of capital, the interest a company has to pay for each dollar that it finances. And I thought it was interesting that Patterson UTI's return on invested capital is negative 6.22% as of December 2015, which means that the company is not earning enough revenue to match its cost of capital. And using regression analysis, I predicted a share price of 9.06 based on a comparison of the price of crude oil versus the share price historically over a period of 5 years. This slide shows the summary output of my analysis. You can see that results are statistically significant and have a high correlation due to the low p-value and high r-square value. And with my calculated price of 9.06, this is a growth rate of negative 40%. And when I performed my regression over the past 2 years instead of 5 years, the share price was much lower. And this was not consistent with my intrinsic value, which was calculated using the discounted cash flow, which will be talked about later. For the growth rate, has been kind of all over the place for sales, mainly due to internal factors. But you can see again in January 2015, it really took a hit, decreasing their sales. And as production prices continue to fall, I believe that Patterson UTI, with their current strategy, which doesn't seem to be working to weather the storm of the low prices, I don't believe that it's going to help them increase their growth rate at all. But their saving grace is their involvement in natural gas. While this is a seasonal industry, it's very constant and expected to continue growing as technology improves. Demand is predicted to increase globally, particularly in the industrial and residential markets. So based on this analysis, I believe that the growth rate will stay at negative 40% for around a year, following the trend of last year. And that's also based off my prediction of the regression analysis. And then that will grow to negative 10% within at least 2 years, which follows the industry average for crude. And then based on Patterson UTI's investment in natural gas and its increased demand, I think the growth rate will eventually become positive. So the discounted cash flow valuation. The intrinsic value is much lower than the stock's current price of $19 per share. And while this estimate may seem a little bit too aggressive with my negative growth rates, it does show that if the company does not turn its growth rate around, it will be in serious financial trouble. And based on this rough estimate, though, the company just doesn't seem like a good investment. Between this analysis, which came out at $8.07 per share, and my regression analysis, which came out at $9.06 per share, which are both nowhere near close to the current price, I think it's safe to say that this company really needs to turn its growth rate around. In addition to this, I checked the Altman Z-score, which is an indicator of bankruptcy, and with their ratio of 1.6, they're in the distress zone currently, which means that they have more than an 80% chance of bankruptcy in the next 2 years. So in conclusion, Patterson UTI is doing the best it can to weather the current low petroleum prices, as they are clearly cutting into sales revenues and profit margins. Their current strategy is to reduce equipment costs by preserving equipment and shutting down rigs as they're no longer needed to reduce operating costs. But at this rate, though, if the market doesn't turn around, the company will be in some serious trouble, as its revenues are not covering the investment for its capital expenditures.